Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 6th of May. I'm Daniel Lam, your host for the podcast. Last week was very eventful in the financial markets, both in terms of the moves, but also in the macro data and details, and that's especially so for the non-farm payroll. Now, after several consecutive strong prints, it declined substantially this time, from 315,000 to 175,000, and that's below expectations of 243,000. Average hourly earnings growth slowed down in April and came in below expectations. And meanwhile, the unemployment rate rose from 3.8% to 3.9%, and that's also surprising expectations on the upside. Digging deeper, government jobs, as well as leisure and hospitality, also added 13,000 jobs in April. These two sectors have been adding workers at a combined rate of roughly 100,000 per month over the past year, so this is a very sharp slowdown. And is a very important piece of detail because this is likely to affect the economic data releases this month, especially the ones such as retail sales and personal consumption. But both equities and bonds reacted very positively on Friday on the back of this news. So why was that? Well, because it helped to alleviate the emerging narrative about fears of a rate hike this year. Now, the S&P 500 held its support around 5,000 and then rebounded and broke above its near-term top at 5,123. And the US 10-year Treasury yield dropped sharply and is now below the important 4.5% level. The DXY index, i.e. the US dollar index, also pulled back and is now sitting around the 105 level. So this initial reaction of asset prices on Friday may represent the start of a shift from the view that the US economy may suffer from overheating to the US economy slowing down at a measured pace. Now, from the technicals indicated above, you may see some short-term rotation back into US assets. And also, this may take some steam off the rally in Hong Kong China equities, which acted as a sort of safe haven over the past couple of weeks on the back of uncertainties in the US macro and also in the future guidance of mega-cap US growth companies. And that means the Hang Seng Index can pull back to the 17,500 support level. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.